Options. For many people, that sounds like rocket science, like Wall Street jargon and enormous risks. But the concept behind it is simple. A contract that gives you a right, not an obligation. In the next few minutes, you'll learn what a call and a put are, what the Greeks do to the price, and why the term implied volatility isn't nearly as scary as it sounds. Let's get started. Before we get into technical terms, a very simple question. What are options actually good for? Picture two situations. First situation, you own shares and you're worried about a crash. You'd like an insurance policy that kicks in if things go wrong, but that's fine to expire unused if everything goes well. Second situation, you're convinced a price is going to rise, but you don't have much capital. You'd like to reserve a fixed price so you can join in with a small stake. That's exactly what options are for. Let's look at both, one at a time. Let's start with the insurance. Say you own 100 shares of Apple, currently worth $100 each, and you're afraid of a crash. You buy the right to sell your shares at $95, no matter how far Apple falls. That right is called a put, and for it, you pay a small premium up front. Let's say, to keep it simple, $2 per share. If Apple now drops to $80, you still sell at $95. Your loss is capped, just like with full coverage insurance. And if Apple rises instead, then the insurance expires unused and it only cost you the premium. Now the second situation, the reservation. You're convinced Apple is going to rise, but buying 100 shares costs $10,000, and that's too much for you. Instead, you buy the right to purchase later at $100. That right is called a call, and here it only costs you $200. If Apple rises to 120, you still buy at 100. The difference, minus your stake, is your profit. And if Apple doesn't rise after all, then you lose at most the $200. Taking part in the big move with a small stake, that's the leverage effect. Up to this point, you were always the customer paying the premium. But every insurance policy also needs an insurer, and you can take on that role just as easily. Whoever sells a put offers someone else the crash insurance and collects the premium immediately, but has to take the stock off their hands if things go wrong. And whoever sells a call rents out the upside chance and also collects the premium, but has to deliver if it's called for. In short, the buyer pays and may, the insurer collects and must. Exactly how this role swap works mechanically and why time decay plays the leading role in it, we'll look at in detail in a moment. These two examples already contain all four terms you need for options. First, the underlying, the asset everything refers to, in our case, the Apple share. Second, the strike, also called the exercise price, the fixed price at which you're allowed to trade, 95 for the put, 100 for the call. Third, the expiration, your right is valid until a fixed expiration date. And fourth, the premium, the price of that right, like an insurance payment, here $2 per share. Underlying strike, expiration, premium. Remember these four. Let's sum up briefly. An option is a right, not an obligation, the single most important sentence of all. And you already know its four building blocks: underlying strike, expiration date, and premium. This is what a real contract looks like. Apple, a put with a strike of 95, expiring in July, premium of $2. Exactly the four building blocks we just gathered are in every single options contract. Before we go on, a basic term you'll run into everywhere: market direction. If you expect prices to rise, you're bullish, like a bull thrusting its horns upward. If you expect prices to fall, you're bearish, like a bear swiping its paw downward. You'll need these two words in a moment: A call is a bullish bet, a put is a bearish one. There are exactly two basic forms, the call and the put. A call gives you the right to buy the underlying, so you're betting the price will rise. A put gives you the right to sell the underlying, you're betting the price will fall, or you're using it to hedge an existing position. Think of the call as a buy option and the put as a sell option, and everything else becomes much simpler. Every option strategy, no matter how complex, is built from combinations of exactly four building blocks: long call, long put, short put. Long means you buy the option and pay the premium. Short means you sell it and collect the premium, but you take on an obligation in return. Iron condor, butterfly, wheel, they're all just compositions of these four basic forms. If you understand the four, you essentially understand everything. Buyer and seller of an option play a zero-sum game. What one gains, the other loses. As a buyer, you pay the premium, your maximum loss is capped at that premium, and you need a meaningful price move for the trade to pay off. As a seller, also called the writer, you collect the premium immediately and profit if the option expires worthless. In return, you carry an obligation and greater risk. Time decay is your best friend as a seller and your worst enemy as a buyer. Let's sum up buyer and seller once more, crystal clear, because this is exactly where many people get tangled up at the start. A long call, you may buy, and you pay the premium for it. A short call, you must deliver if it's called for, and you collect the premium. A long put, you may sell your insurance against falling prices, and a short put, you must buy if it comes to that, and you receive the premium. The memory hook: whoever buys, pays and may. Whoever sells, collects and must. Here's a detail that surprises many beginners. One options contract standardly covers 100 shares. So if you see an option with a premium of $2, one contract doesn't cost $2. It costs $200. That's the multiplier of 100. This leverage is what makes options powerful. But it also makes clear that seemingly small premiums represent real amounts of money. Always multiply by 100 and you'll get a feel for the real numbers. There are three terms that describe where a strike sits relative to the current price: in the money, at the money, out of the money, ITM, ATM, and OTM for short. A call is in the money when the strike is below the current price. You could exercise it and profit immediately. A put is in the money when the strike is above the current price. When the strike sits right at the price, it's called at the money. When it's further away in the wrong direction, it's out of the money, cheaper, but with a lower probability of moving into the money. These three position descriptions come up in every single options discussion. The premium you pay for an option consists of two parts: intrinsic value and time value. Intrinsic value is the amount you'd receive right away if you exercise the option now. It's only greater than zero for in-the-money options. Time value is the rest, the expectation that the price might still move in the right direction, and that time value erodes every day continuously until it has fallen to zero on expiration day. That's the central mechanic driving everything else. Why does the price of an option change even though the stock has barely moved? Or why does an option suddenly become much more expensive right before an earnings report? There's a family of metrics named after Greek letters for that, the so-called Greeks. Each one measures a single force acting on the option price. Let's walk through the four most important ones in order now. Delta tells you how much the option's price changes when the underlying rises by $1. A delta of 0.50 means if the stock rises by $1, the call price rises by 50 cents. At the same time, delta is a rough rule of thumb for the probability that the option will be in the money at expiration. An option with a delta of 0.30 has roughly a 30% chance of finishing in the money. Calls have positive deltas, puts have negative deltas. Theta is time decay, how much option value is lost every day purely through the passage of time. An option with a theta of -5 loses $5 of value every day, all else being equal. The closer expiration gets, the faster this decay accelerates. As a seller, theta is your greatest ally. Time is working for you. As a buyer, it's the other way around. You're fighting the clock, because even if you're right about the direction, time decay is eating into your position every single day. Vega measures how sensitive an option is to swings in implied volatility. If implied volatility rises by 1 percentage point, Vega tells you how much the option price increases. Imagine an earnings report is coming up, the market expects a big move, so implied volatility rises, so options get more expensive. If that expectation fades afterward, implied volatility drops, and so does the option price, even if the stock has barely moved. This phenomenon is called a vol crush, and it's one of the most common surprises for beginners. Gamma is the delta of delta. It describes how quickly delta itself changes when the price moves. For options near the money and close to expiration, gamma is especially high. A small price move can then massively change delta. That makes gamma the most exciting variable, but also the trickiest. As a beginner, it's enough to know this. High gamma means your position becomes more sensitive quickly as the price gets closer to your strike, in both directions. Implied volatility, IV for short, is the real price driver in options. It's not a historical figure, but an expectation. How much does the market expect the underlying to move by expiration? The higher that expectation, the more expensive options are. Whether IV is currently high or low depends on comparison with the past, and that's exactly what IV rank shows. It places the current IV within its own historical range, from 0 to 100. An IV rank of 80 means IV is currently higher than on 80% of all days in the period being measured, so options are relatively expensive, and that's often a good environment to become active as a seller. Let's look at this with a concrete example. You find a stock interesting, currently trading at $100. You sell a put with a strike of 95 that expires in 30 days, and for it, you collect a premium of $2 per share, that's $200 per contract. At the same time, you set aside $9,500 as collateral. Now, there are two scenarios. If the stock stays above $95, the option expires worthless, and you keep the $200 as pure profit. If the stock falls below $95, you get 100 shares delivered at the strike. But your effective cost basis is already reduced to $93 by the premium. So you're buying a stock you wanted anyway, cheaper than the market is currently offering it. A few mistakes that beginners make over and over and that you can spare yourself. First mistake, naked short calls. If you sell a call without owning the stock, your risk is theoretically unlimited. If the stock surges, you have to deliver at a much higher price. Second mistake, forgetting the expiration date. On expiration day, an in-the-money option can be automatically exercised. If you weren't paying attention, you can end up with unwanted shares in your account, or you might have to make delivery. Third mistake, trading illiquid options. Wide bid-ask spreads eat up your edge before the trade has even begun. Liquidity matters just as much with options as it does with stocks. But knowledge is only half the journey. If you actually want to apply what you've learned, you need two things: a place to keep learning and a tool that has your back in everyday trading. Let's start with learning. This video is just the beginning. In the sTraderZ Academy, you'll find the complete toolkit, a foundational handbook on options, the Greeks and strategies, printable cheat sheets for everyday use, and learning paths that take you forward step by step. And once you start trading yourself, sTraderZ.com keeps everything in view. The platform automatically recognizes your options strategy and the entire trade cycle, from opening through rolls all the way to closing. You see right away which strategy is actually making you money: win rate, profit factor, and a cumulative profit curve across all your accounts. And at year's end? From your options trades, sTraderZ.com generates a ready-made tax report, writer and forward transactions correctly recorded, annual result, and estimated tax burden included, as a PDF ready to attach to your tax return. No more piecing it together by hand. 3 things to take with you. First, an option is a right, not an obligation, the foundation for everything that follows. Second, the Greeks measure the forces acting on the price. Theta is the seller's friend. And third, implied volatility is the real lever. Anyone who understands when options are expensive or cheap has a genuine edge. Next up, we'll look at the wheel strategy, the most elegant way to connect these building blocks into a system. You'll find all the links in the video description.